All right, let's jump right into this explainer and unravel the completely tragic mystery of how America's absolute darling of a company turned into its biggest nightmare. I mean, imagine for a second investing your entire life savings into a business that literally everyone loves. Wall Street is raving about it, business magazines are slapping its CEO on their covers, and financial analysts are practically begging you to buy the stock. Everything looks perfect, right? And then, almost overnight, the whole thing just goes up in smoke. Now, this isn't some Hollywood script. This is the staggering, totally true story of Enron, the corporate scandal that completely rewrote the rules of the business world forever. $74 billion. Just let that number sink in for a second. That is the sheer scale of the devastation here. Wealth that simply vanished into thin air. It wiped out the retirement savings of fiercely loyal employees who trusted the company, and it cost investors billions, destroying portfolios almost instantly. We are talking about one of the most spectacular, jaw-dropping corporate frauds in human history. So the obvious question is, how did executives build this massive illusion and actually keep it hidden in plain sight? How on earth do you trick the smartest financial analysts in the room? How do you project this image of totally unstoppable growth while the foundation beneath you is literally rotting away? Well, to understand the epic collapse, we really have to look at the climb. Chapter 1: The Rise of an Illusion. The origins of this massive facade trace back to 1985, starting off pretty simply as a merger of two natural gas companies under CEO Kenneth Lay. Now, Wall Street absolutely loves innovation, right? And Enron gave them exactly what they were craving. Instead of just staying a boring, predictable energy company, Enron aggressively morphed into this massive trading empire. They weren't just dealing in natural gas anymore, they were trading electricity, broadband internet bandwidth, and get this, even financial contracts based on the weather. Yeah, the weather. Investors were absolutely hooked. They really believed Enron was the ultimate future of American business. Fast forward to the year 2000, and this super aggressive strategy pushed Enron's reported annual revenue past the $100 billion mark. Honestly, that astronomical figure sent their stock price straight into the stratosphere. And tragically, employees were so confident in this supposedly flawless wealth creation machine that they tied up their own retirement savings in company stock. From the outside looking in, Enron was just untouchable. But part 2, hiding the truth. Because as we know, looks can be incredibly deceiving. Behind closed doors, Enron was dealing with some massive financial problems that they desperately needed to keep quiet. Okay, so here's their first magic trick, a highly controversial practice called mark-to-market accounting. Basically, under certain conditions, this allowed Enron to immediately report projected future profits right onto their current books. You see the massive problem there, right? They were booking these gigantic wins on paper for money that literally did not exist in the real world yet. It's like counting your chickens before the eggs are even laid, and then pretending those imaginary chickens are worth millions. But what about the other side of the ledger? What about their skyrocketing debts? Well, they turned to things called special purpose entities, or SPEs. Now, these were insanely complex legal and accounting structures that executives completely misused to literally shove their massive liabilities into the shadows. By sweeping that debt off the company's official balance sheet, their financial position looked totally rock solid to the public. So you end up with this totally crazy split reality. On paper, they were a Wall Street darling, just this pure illusion of unstoppable success. But that completely masked the reality of the situation. A company that was absolutely drowning in hidden, toxic debt and surviving on dangerously weak cash flow. So who exactly built this facade? Well, you've got founder and chairman Kenneth Lay, the guy constantly hyping Enron to the public as one of America's greatest companies. Then there's CEO Jeffrey Skilling, the real champion behind their wildly aggressive expansion model. And finally, CFO Andrew Fastow, the absolute architect of those shadowy off-balance sheet partnerships. Together, this trio built a totally impenetrable image of success, all while the internal risks just kept compounding. Which brings us to part 3, the house of cards falls. Because by late 2001, people finally started asking the tough questions. Why are company insiders quietly dumping their stock while publicly telling everyone else to buy? And internally, you really got to give massive credit to whistleblower Sharon Watkins. She saw the massive discrepancies in the numbers and actively raised the alarm. She explicitly warned senior leadership that these wildly complex accounting practices were a disaster waiting to happen, making her one of the very first to shine a light on the sheer scale of the rot inside the company. When the dam finally broke, the speed of the collapse was truly terrifying. I mean, we're talking about a matter of weeks here. Week 1, major accounting corrections have to be announced. Week 2, the credit rating agencies downgrade the company. By week 3, investor confidence completely evaporates and the stock price craters. And week 4, Enron officially files for bankruptcy. In less than a month, an American giant was completely wiped off the map. Moving into part 4, the aftermath and laws. The fallout here was absolute total devastation. People didn't just lose their jobs, they lost their entire retirement accounts in one fell swoop. And the blast radius hit the global financial system hard. Because it wasn't just Enron that went down. Even their external auditor, Arthur Andersen, which was once one of the most respected accounting firms on the entire planet, was pulled right down with them. Accused of improperly destroying documents related to the audit, the blow to their reputation was fatal. This single corporate scandal effectively erased a global accounting giant from existence, and they ultimately ceased auditing public companies altogether. Just incredible. Things were so bad that the United States government literally had to step in. In 2002, they passed the Sarbanes-Oxley Act. This was a massive reform designed to drastically strengthen corporate governance, tighten internal controls, guarantee auditor independence, and actually hold executives personally accountable. The whole point was to force transparency back into a completely shattered system and try to restore some level of investor confidence. Finally, part 5, 5 lessons for investors. Let's talk about what this whole saga actually means for you and me, and how to protect our own money. Keep these 5 golden rules in your back pocket. First, always research the actual fundamentals. Do not just invest based on a company's stellar reputation. Second, favor simple, understandable businesses over insanely complex financial webs. Third, pay attention to actual real-world cash flow, not just paper profits. Fourth, and this is so absolutely crucial, diversify. Never, ever put all your retirement eggs into a single company's basket. I don't care how much Wall Street loves them. And fifth, always demand transparency and ethical leadership. Ultimately, Enron is the ultimate warning sign of what happens when unchecked ambition meets totally weak oversight. They built a magnificent, towering house of cards, but a house built on illusion will always, eventually, collapse under the crushing weight of the truth. True sustainability takes real financial management, not just clever parlor tricks. So, as we wrap up this explainer, I want to leave you with a thought, really to get you critically evaluating your own portfolio. If a company that was universally praised could so completely fabricate its reality, how confident are you in the numbers backing your investments today? Keep asking the tough questions, demand transparency, and never stop looking behind the curtain. Thanks for joining me to unpack this wild story.